Hello, and welcome to our first Wealth Management Invest episode of 2025. Your host, David Bodamer, with the wealthmanagement.com editorial team. Thanks again for tuning in. To kick off the new year, we have with us Brendan McCurdy, who is the managing director and co-head of the Financial Advisor Solutions team within the Wealth Management Solutions at Ares. So, Brendan, welcome to the podcast.
Thank you. It's really nice to be on, David.
Great. We've talked in the past. I'm happy we're connecting again. I think we did an interview a few months ago for on the website that I hope folks can maybe go look at. But excited to drill a little deeper with you in what's going on. But maybe just to start things off, if you could tell us a bit about yourself and about what is the Financial Advisor Solutions team and how it fits within Ares overall.
Yeah, absolutely. Happy to. Thank you. So, Ares, to start off, is one of the largest alternative or private market asset managers in the world. So we focus just on the big four food group within private markets, which are private equity, private credit, private real estate, and private infrastructure. And then within that, the wealth channel, we're here to support those private markets going out to private wealth, meaning individual and investors, but of course through their financial advisors. And so we're talking mostly to financial advisors as well as a family office and multifamily offices. And then within that wealth group, as we're out speaking to all these great investors, we get so many questions on what's going on in the macro environment and how does that relate back to the private market asset classes, and people wanting to do deep dives and have further education on each of those four asset classes, the private equity and private credit, and in both private infrastructure and real estate. And so the sorts of things that our team does, you can think about it as a research team. Our research team, we publish lots of pieces, which people can find on our website, accessares.com, on all different topics, both what's going on more generally in the environment, on each of the private market asset classes, and then as well as how those private markets relate back to portfolios that investors and financial advisors and family offices are trying to build. So how do you think about those private markets within the context of a total portfolio, including all the public market investments that folks already have?
Yeah, and I think what's always interesting when I think about this is that private markets sounds like such a simple phrase, but it just gets very complex very quickly because, as you talked about, there these kind of four major food groups that folks talk about. But even within that, there are different flavors or different, for example, in real estate, there are different property types that are up and down at different times, in different way, and whether you're looking at the debt or the equity side. So suddenly, like I think there's like the sentiment that like, yeah, we should have access to private markets and we want to get in here, but then it can get very complex very quickly. So how do you it seems like that's one reason why maybe you're doing these, breaking things down and providing a lot of analysis, but how do you kind of crack that egg and helping people understand and implement private markets?
Yeah, in some ways, the private markets can be quite simple. Private credit is making loans. Private equity is owning businesses, and I think very often, when we're speaking with investors, I think a lot of people build their wealth through owning private real estate or through owning a business, and so they very quickly pick up on the private markets because they've already essentially been doing it and involved in it their whole life. And so, yeah, at the most basic level, I do think private markets are actually quite simple. But to your point, you can always start to slice and dice things different ways. And so I'd liken the private markets very much to the public markets. So just like in US equities, you have the Morningstar style box, right? That 3x3 matrix that helps you think about large, mid, and small, and value and growth. In the same way, you can take an asset class like private equity, and we find there are really four sub asset classes that you can look at within private equity. So instead of splitting up in kind of 9 different ways, in private equity, we'd really look at venture capital, growth, buyout, and distressed as being the four sort of sub asset classes to private equity that follow the life cycle of a private company. Similarly, within private credit, you could break that down to first lien loans, which are the highest quality secured loans, and then Next under that, you have second lien. And then under that, you have like preferred and mezzanine getting into distress. So each of those four main food groups has roughly four different sub-asset classes that you could think about. Doesn't mean that you need to be in all of them or cover all those boxes. When you're looking at either infrastructure or real estate, you have core and core plus assets, which are a little bit more bond-like in terms of being lower risk and assets that are already uh, up and running and cash flowing. But then, of course, you can move up towards more value add and opportunistic, which are more equity-like flavors of real estate and infrastructure. You don't necessarily need to have those all in the portfolio, but since those terms get thrown around out there, and of course there are strategies that cover each of those different sub-asset classes, then yes, we're out there talking about them and helping people understand the differences so that they feel confident as they're going out and doing their due diligence.
And is one of the goals for Aries to provide access points to all of what you just talked about?
Not to all of them. That's a
That's
great
all of
point.
them.
So at Aries, we do build individual strategies for allocators. So that's our goal. There are certainly some private markets managers that try and build, strategies that are kind of include all asset classes and are a one-stop shop. But we really try and build strategies for allocators, individuals that want to choose how much to have between private equity and private credit and private real estate and private infrastructure. So we do have strategies for each of those four main food groups, but we're not necessarily then going to have each of the underlying flavors. So we really don't do much with venture capital and growth within private equity, for instance. While our teams do opportunistic and development real estate, the strategies that we mostly talk with wealth investors about are more on the core plus. So we do have our goal is to cover each of the four main food groups with individual strategies and let allocators choose how to use those and how to weight those, but we won't have every underlying sub-asset class.
And from an access point perspective, there's been this proliferation and some innovation happening around, like, historically when you think private markets, you think of like the drawdown vehicles, larger minimums and accessing at that point. But there has been this development in this big rush of limited liquidity vehicles. There's been talk of SMAs for private assets. What are you looking at in terms of, like, on that side in offering, which investors you're targeting and what the entry points are?
Yeah, so we across each of those different food groups will have two or three access points generally. And the two main access points, as you mentioned, the traditional, more institutional 10-year lockup drawdown type strategies. So we certainly have those across almost all of both the major food groups, but then each of the sub-asset classes within those. But then on what the industry tends to refer to as either perpetual or evergreen type strategies. So more like a mutual fund or an ETF, and that you can get in each month. There's some amount of liquidity that's offered, and you can stay in as long as you like, and the funds don't wrap up after 10 years. They continue on, hence the name Evergreen. So you get the same sort of content, but depending on the investor and whether that investor has a big team built up. When you think about big institutional pensions and sovereign wealth funds, they have massive teams that all they do is think about how many new commitments they're making and how much they're overcommitting and how many capital calls they're likely to get this year and how much in distributions they're going to get back and to match those things up. But that's difficult for even large and medium-sized institutions, and is typically not practical for the wealth channel. And that we're in this really nice position where we get to be neutral, which structure investors use, and we try and offer both, and particularly in those kind of the big parts of the food groups, like the core plus in both real estate and infrastructure, as well as in, for instance, private equity secondaries or first lien private credit.
And so, as you know, we are pretty early in 2025. There's a lot in motion on the kind of macroeconomic, socioeconomic, political, whatever. There's a lot of stuff in motion right now. What are some of the? Are there? How is that affecting maybe how you're looking at some of the different asset classes? And do you see any maybe shifts? Like, for example, I'm thinking like, private credit's been very popular for the past few years, like among those buckets you talked about. Do you see that maybe shifting at all in 2025 and like in among those asset types?
There are little shifts for sure. So maybe I take a run through each of the major asset classes and kind of let you know just what we're seeing right now in the
Mm-hmm.
market. I will say that most investors, and we do encourage them to think about their private markets exposures being more strategic. They should be, longer term dollars, longer term time frame. But certainly around the edges, there are times when you see that valuations are more or less attractive in certain asset classes. And so while most of the investing in private markets should be strategic, I think investors, are always curious about, is there a sort of tactical play or more interesting asset class or investment at the moment. So as I kind of walk through each of them, on the private equity side, it's been a little bit of a tougher last couple of years for private equity. Generally, a little bit more muted returns, and typically the low to mid single digits, so positive. But I think when you compare it to the public equity markets, it's certainly been more muted, and we're looking forward to deal flow coming back into private equity this year. And because you've had this big run up in the public equity markets, whereas valuations, so think about like, price to earnings ratio has stayed very constant in private equity over the last couple of years. You actually have this really big gap right now where valuations are about half in private equity versus what they are in the public equity markets. And so we've seen a lot of investors starting to really notice that valuation difference or valuation gap. And in the past, history has shown that when you have that big gap between valuations in the public and the private markets, that tends to be a really opportune time to start getting into private equity. So we do, we are starting to see investors thinking about taking some chips off the table in the public equity markets. They've had great returns and starting to take some of that and put that into private equity, which tends to be less volatile, and you're getting in at a better price. So we do expect to start to see more of a turn in private equity this year for the positive. In private credit, if you and I had talked 18 or 24 months ago, I would have been pounding the table and said, you have got to put everything you can into private credit right now, because it was just that attractive. Spreads were so wide, meaning the amount that we were getting paid for the risk that we were taking on was just so wide 18 months ago. And that really came because the banks, which are big lenders, of course, to companies, the banks had stepped out. They had stopped lending in a lot of ways. And so there just wasn't nearly enough capital in the private credit markets to make all the loans that companies across the US and also outside the US were demanding. Now the market, I'd say really, especially getting into the back half of last year of 2024, the private credit markets come in a much better balance, where now you've got better balance between supply and demand of capital. And so, we've seen spreads, depending on the size and the type of the loan, but in those highest quality first lien loans, you're seeing spreads roughly in sort of the 5% range. And when I talk about a spread, I'm talking about how much you're getting paid over and above the risk-free rate. So these loans are all floating rate, and they float above SOFR. Most of them are set to SOFR as the risk-free rate. So you're seeing spreads right at long-term averages, roughly in the 5% range. The upfront fees that we're getting on those, very often around, 1.5%. Again, right on at long-term averages. So private credit looks really healthy in terms of the balance. I don't think it's the, roaring overweight that it was 18 months ago, but the market looks well balanced. And, we'd expect average type returns for private credit and those first lien private loans over the last 20 years for the market. Generally the return's been high single digits, low double digits in that space. So that's kind of what we'd expect there. So I think you're very safe to be at your strategic weight as you're thinking about private credit. And then private real estate and infrastructure, I think, are the ones where we'd start to get a bit more tactically excited this year. Real estate has been, of course, a little bit more beat up over the last couple of years as the Fed started raising interest rates in 2022 and into 2023, not just raising them, but raising them very quickly, as well as, There's quite a bit of building, particularly in industrial and multifamily, and we all know the kind of hangover issues that existed from the office space and work from home. Real
Mhm.
estate got beat up the last couple of years, and in the mid part in the summer of last year of 2024, we started to really see a bottom forming, and we were very vocal about that. If you look on our website, you'll still see a lot of pieces from kind of mid last year going into this year of us talking about, hey, we really see a turn happening in real estate. So we're starting to get excited about real estate. Not all sectors necessarily. I think we're still very often cautious in office, but we see really good fundamentals within industrial. And when I talk about industrial, I'm not talking about factories, but I'm
Right,
talking
like
mostly
warehouse,
warehouse
like
and logistics. Yep.
yeah, logistics spaces. Yeah.
Exactly. And multifamily is starting to show a lot of the same trends where you just haven't had a lot of building. And so there's not enough supply to meet all the demand. And especially with the economy so healthy, that means there's been lots of uptake of space in those two sub-asset classes or those two sectors. And we've seen really strong rent growth, and we're starting to see prices of the underlying properties respond. So not only are you getting a good yield, and typically that yield has nice tax benefits, so really nice tax equivalent yields there, but we're starting to see some good price appreciation come back. So we're getting really excited about real estate. Infrastructure is then the final one, and that's just more long-term, really strong secular tailwinds. Listeners are probably familiar with the fact that for 20 years, electricity usage around the world, but especially in the U.S., just plateaued. Whereas now, over the past year or two, we're starting to see a really big pickup for the first time in decades in electricity usage, and that's coming from all sorts of areas. A lot of it certainly is coming from things like more electric cars, an awful lot of it coming from artificial intelligence and the amount of power that sucks. Folks might know that an AI query takes roughly 10 times the amount of power as a normal internet search, a Google search. And if you're creating images or videos, that can be anywhere from 50 times to 10,000 times the amount of power. And so all these data centers from AI, but also from the VR and gaming that we use, the digitization, everything that we stream, automation, the Internet of Things, having our cars and our sometimes refrigerators and all the robots in those warehouses, those industrial properties talking to each other. That all sucks massive amounts of data, which sucks massive amounts of power. And so infrastructure, we see actually a generational opportunity forming around the data centers themselves, but then around
Mhm.
the power that actually is needed to supply those, and then everything that hook those up, the fiber, the 5G, the lines to connect all the power. So a lot more I could get into there, but infrastructure is going to be a big one for the next 5 years.
Yeah, I was actually curious thinking about like where the data center thing fit in, whether that's a real estate play or an infrastructure play. It sounds like it's almost maybe a combination of both. But
It,
like,
it
or
is.
how you access it from the private markets, because there's also like a bunch of big public REITs that do data centers. So what you just like kind of quantifying the private market opportunity on that asset class.
Yeah, I think you'll see private market managers categorize it in both real estate and infrastructure, depending upon who you speak with. I can just tell you from the Ares standpoint, the data centers themselves, we're thinking about a little bit more as real estate, and then
Mhm.
the power to supply them, as well as the interconnections and the fiber that connects them, that bit being more infrastructure. And I think a lot of the other firms out there kind of roughly categorizing it the same, but I think it's a little bit less important which category you throw it under, and
Sure.
more important just that you have that exposure to it.
Yeah, just being able to identify. I mean, because it's also like such a you know sophisticated kind of a building, even if you're just looking at the individual data center. But
That's
yeah,
right.
as you're talking about but these power requirements or the technology that goes into running it, you kind of really need to be a very sophisticated operator to do it. So I guess that's part of what you're doing too, is like identifying best in class people to invest in, or how you find it's not something that, like, unlike like a warehouse, for example, which like is just a vanilla box that a
Yeah.
lot of people could do. Building a data center is a very different beast. So being able to
Yeah.
find that opportunity, that seems like a very interesting challenge.
You're exactly right. It's, siting it, getting the location right so that you have access to the power and preferably very consistent power at a good price. All the cooling that goes with it, the weight of all those
Mhm.
racks can be incredible. And so supporting that, all the backup systems in generators, latency lag, there are an awful lot of different factors that you need to take into account. And not to mention they're just really big projects, right? It doesn't really do much good to build a small data center. At this point, most of the projects are going to be $1 billion or above to create, one new one. And so you're really talking about projects that are at a scale, and then plus the expertise that's needed. That, yeah, there are only so many developers and then operators that can really do that. So I think you're absolutely right there.
Right.
Maybe
Because
it's
I think
just
another like notion that people have had, which doesn't really then square, was like, oh well, we have these office buildings which are empty, or maybe could we
eh,
repurpose those as a data center? And it's like, well, not with like, if you're
yeah.
not with the kind of equipment and all these things that you're talking about. Like, you can't, the floor plates won't, the cooling, none of that would be adequate for like turning it into actually the kind of top modern data centers that you're talking about.
Yeah, that's exactly right. I love the creativity and thinking, but practically, you won't really be seeing that.
I think, when we talked also for the interview, another interesting opportunity that you identified was like the sports investment opportunity. So I don't know if that's something you could also touch on here.
Yeah, absolutely. It's been, I mean, anyone can kind of look it up in the news. The media loves picking up the stories because there is absolutely, an excitement about investing in. We categorize a broader category: sports, media, and entertainment. But certainly, I think sports has probably captured the most attention and excitement recently.
And I think, one of the things that you pointed to at that point was, that's not just thinking about the opportunities in the teams themselves, but potentially in programming, bringing expertise in how to program like an arena, and to make it a more of a 365 day of a year thing. And just like finding like adding some value alongside the investment.
Yes. So to get into it a little bit more, yeah, I think the first thing that folks think about when they, think about sports is they think about the individual teams. And
Mm.
there's no doubt that, we and a select few others are investing in individual teams, but then there are other layers to that. So there are if you go up layer up, that's the leagues themselves. And then as you start going layers down, you be looking at sports equipment suppliers. You can be looking at youth leagues. There's some really interesting things happening in new leagues coming up. So, for instance, there's been a lot of press around League One volleyball, which traditionally certainly hasn't been one of the big four in the U.S. But we think there are really interesting opportunities in women's sports, in some new and upcoming sports. And then, yes, even within an individual team or a franchise, it's not just about the team itself, but it's, do you have the stadium? Does the stadium belong to, municipality or the city, or does it belong to the team? Because there's so many interesting things that you can do with the real estate around those teams, with the arena itself, with finding ways, especially if you think about an NFL team, you might only have, 6 or 7 home games a year. What about the other, 358 days of the year? And so the ability to use those for concerts, and there are lots of really interesting examples in London, in Philadelphia, in Milwaukee, and Atlanta of teams that have found ways to integrate kart racing and concerts, skydiving, different or bungee jumping rather, different experiences, and make these really 365, 24/7 living, breathing, interesting communities and neighborhoods that have not just the entertainment aspect, but then wrap in retail and sometimes office, commercial, and residential to really become new neighborhoods and communities unto themselves.
Well, I'm sure there's a lot more I can be asking you, but we're taking up a chunk of your time here, so probably gonna need to cut this off. But before we do, I just wanted to thank you for your time again, and also, if there was anything that we didn't address that you think would be particularly important, or any kind of takeaways that you want to leave, I just wanted to give you a chance for a last word.
Well, no, thank you, David. It's always a pleasure to speak with you and to be on wealth management. I think maybe just the final thought. We covered so many different topics in terms of different asset classes, the sports, the macro, and we are constantly putting out new pieces and thoughts on these. So for anyone who's interested to kind of hear the latest and what we're seeing, please do go to accessaries.com and you can follow both what we call our private market insights and our fast takes and other pieces there, as well as just even through LinkedIn. I'm constantly posting our new pieces on LinkedIn, so folks should feel free to look me up and follow me there. And those are great ways to see what we're seeing live at the moment. We try and be as transparent as possible about everything going on in the private markets.
Well, thanks again, Brendan, for your time.
David, how can people get in touch with you?
You can also find me on LinkedIn. I probably should post more than I do, but trying to get better at that.
We all should, right?
but primarily, the investment category at wealthmanagement.com is where you'll find all of our coverage, of private markets, but also other investment trends, SMAs, ETFs, all the kind of investment strategies that financial advisors are looking at these days.
All right. Well, thanks to both of you, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.